Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah. The next 30 minutes we talk all about mutual funds, try and talk about some of the pressing questions and talk about an issue which I think a lot of people grapple with, especially in times which are very, very volatile. To talk about all of this with me is Vijai Mantri, founder and chief investment strategist and mentor at JRL Money. Vijay, good having you as always. Thanks so much for joining in.
Thank you very much.
Now, before we get to the topic at hand, which is the main topic of the conversation, there is a pressing question that I would want you to answer. Very recently, in the last 7 days, one of the things that has happened in mutual funds is that AMFI has released guidelines, the Association of Mutual Funds body that is, has released the guidelines on haircuts to be taken by mutual funds when their investments are downgraded. Now, while these guidelines would be optional in nature, but it's a matter of speaking because AMFI has released it, people would probably be expected to obey them. How does this in any way change the scenario for mutual funds? Is it only meant to get uniformity or is there something else?
I think it is more to show uniformity in the way fund houses value the securities of various nature. So I think it will bring more consistency, but I don't think it is going to change anything dramatic because most fund houses for most of these things were talking to AMFI and valuing it appropriately. Because for instance, loan against shares is a kind of security which doesn't get traded. So how do you value that security? So for that there's a valuation committee at AMFI which advise mutual fund companies how should they value the security. So the purpose is that any existing investor should not suffer too much. At the same time, there should not be any too much leeway given to a potential future investor who can come. Suppose you overvalued the security or you undervalued the security. So to bring consistency and uniformity in the valuation, AMFI issued the guideline. And my sense is that these guidelines will be followed in toto. I don't think there will be deviation from fund houses.
So essentially now, what is the actual valuation of the securities held by mutual funds? Without doubt will be known to almost all investors, right? If initially also, if some fund houses are doing it, maybe there were doubts that whether or not it is available. Now that these guidelines have been released, one would expect that there will be no difference between the actual valuation and what is being shown.
Yeah, and it is very important to understand why AMFI has done it, because debt market in India is not very liquid. So how do you value securities, and why it is important to value security in mutual fund on day in day out basis? Because there's an inflow and outflow happen every day. So inflow happens suppose at inflated or deflated prices, or outflow happen at deflated or inflated prices is not in the interest of any investor. So debt market is very liquid. So and there has been a lot of leeway fund houses used in past. Over the years, AMFI and SEBI as a regulator has come to a situation where most of the securities are valued at, in the opinion of the expert in the market, closer to their realizable value. So the net asset value is also not net available value. So most of the securities are now valued at closer to what potential they can be offloaded in the market. So I think it will bring more transparency, more consistency in which the securities are being valued going forward as well.
Okay, so there you have it. More transparency, more uniformity, more predictability, if you will, of any of the securities held by mutual funds and what the valuation of those could be. But moving on to the main topic, and this topic of conversation came about because once over a cup of coffee, Vijay Mantri told me a very interesting thing, that there is a difference between the fund sheet and the fact sheet by a mutual fund. And the larger context of this conversation was that when we look at mutual fund returns over a period of 5, 6, 7, 8, 10 years, they look good because indeed mutual funds have done well because the markets have done well. They hide what is beneath the water level, right? Which is a lot of volatility, which may actually roil the minds of the investors. Vijay, why is this so important to understand? I'm guessing you brought this up because you believe that investors who come to you as well, while they talk about investing for the long term, do get rattled when there is short-term volatility. And what better period to talk about volatility than now?
So the reason is that I've been into this industry for almost 25 years and met investors across length and breadth of India. And I have seen mutual fund delivering huge return. But whenever you go and meet actual investor, they don't see return on their wealth statement or their account statement. So there's always there's a fund return, there's an investor's return. And then you figure out over a period of time what has been the reason that people are not getting the fund return actually in their portfolio. So I think it boils down to the way investor returns are being communicated to investor. So if you ask me the way fund houses are showing return or the way a regulator's mandatory for fund house to show return, I think the greater need for more disclosure, more information need to be given out to investor. And I thought I'll not wait for MFI or SEBI to come out with these things, but at least communicate to investor that return anybody can see. So return and risk are they go jointly. Return anybody can see, but the risk is a job of expert to show to the investor, hey, you're coming in this product, this potentially is a risk in this product, but in spite of that, I'm asking you to come and invest in this fund. So from that perspective, it is very important. The moment customer understands the risk, he may not invest in your product, fine. But when he invest with full conviction that this has happened in past, the same thing will happen in future, but I'm more aware today before I take a decision.
Okay, you used the example of the HDFC equity fund, the growth plan, I presume, and trying to indicate or explain this better via two metrics, like the internal rate of return and the compounded annual return. Can you elaborate on this?
So internal rate of return is applicable more in case of SIP because you are investing at every month. So there's a cash flow happening every month, and then whenever you look at on a particular date when you calculate the return, you assume cash outflow. So for that, you need to calculate internal rate of return. On one-time investment, you always calculate compounded annual growth rate. So for SIP, it is IRR, and for one-time investment is a CAGR return we calculate.
Okay. Now, what is it that we're trying to say when we are showing these blocks of 1 year, 5 year, 10 year, 20 year returns? Because the one thing that is obvious to me is that the XIRR over different time frames is radically different. Or one would say that over the long term, if you hold, then you make more returns. But there are time periods, even in one of the best quality funds, that the 5 year, 10 year return have looked slightly wobbly compared to the 20 year return.
Yeah, as always the case. Over a longer period of time, the return converge and come closer to what the broader market has delivered. But if you look at this chart, it will give you, it would have given you say 20% return on a 1 year period, 12% over a 5 year, 14% over a 10 year period, and 20% plus over a 20 year period. But when you look at 19% for a 1 year period, it is easier to get 19% over a 1 year period, but very difficult to get 14% over a 10 year period. So the number in absolute term may look lower. So for instance, this number in 2007 end would have looked 60%. But in 2007, 10 year return would have looked 20%. So the longer is the time period, definitely return would come down, because in 1 year you can get lumpy return. So you'll always see this sort of a broad range between 10% to 20%. It depends on what time you pick up, but that should not unnerve the investor. That is not the main point out of this presentation. When someone look at these numbers and you look at 20-year return or SIP and say 20 years HDFC equity fund 24 lakh has become 2 crore plus, 2 crore 64 lakh, 20.5% CAGR. When you look at these return, you get very excited. Oh, this is the kind of return I got, 10-year return around 14%. Then they come to advisor and say, we would like to invest, or advisor approach the customer that this is a fund you should be looking at investing. And they say, okay, what is the downside? So the market will remain volatile. So, okay, not 20%, perhaps I'll get 18%, perhaps I'll get 15%, perhaps I'll get 12%. So that is the kind of thought process goes in the mind of investor. But wait for a few more slides and you'll get to know what actually happened to the investor.
Yeah, sure. Actually, even for a lump sum investment as well of a 1 lakh in HDFC equity fund. And by the way, I think we're choosing this fund because this is one of the funds which has got a long-standing history, and that's why even in the earlier shows with Vijai, we've used the HDFC funds as an example. But the compounded annual return for a lump sum investment, Vijai too, actually over the number of years has shown a steady uptick. There's a small difference between what the SIP returns, XIR returns have been versus the compounded annual returns have been. Yeah,
there'll always be the case because SIP cash flow happen at different point of time. So there'll always will be difference between lump sum CAGR and XIR of SIP. That should not be compared. But if you look at this fund's return over a 1 year, around 15%, over a 5-year 15% compounded. It means in a 5-year time your money doubled. In a 10-year time your money grew 6 times. The fund return has been around 20%. And over a 20-year period, this fund delivered 22% plus CAGR. It means that your 1 lakh has become 55 lakh rupees. And I chose this fund not because of anything else, but it is one of the better performing fund, and it delivered. It has a pretty long track record and largely managed by a single fund manager. But the point is not to show return, but to show the risk. So even in one of the best performing fund, we'll come and we will show in next part of the program that how the return comes by. In equity, we know the destination is very clear, that in the long term equity deliver the best possible investment performance, but the journey is very important, and many times the customers are not communicated, or perhaps there's no way to figure for them out, even for advisor, that what and how the journey has been to get 1 lakh 55 lakh rupees growth.
Yeah, I think that would also happen if the investor would stay invested. Remember, I remember an anecdote, and we'll go to the next chart as well, but I remember an anecdote that a lot of investors or a lot of funds in the US which did very well over long periods of time had investors who either forgot that they had this investment or were dead because the money stayed in the fund for a really long time and there was no churn. So staying invested maybe has its benefits. Vijai, you've given us this excellent set of calculations in 11 by 11 grid. Would you come here and tell us what is it that you mean to show when you're talking about this? Because this chart will come up on your screen, or this set of blocks will come up on your screen. And this is again the HDFC Equity Fund growth plan, the returns percentage CAGR, speaking about the benefits of staying invested. Vijay.
So suppose you look at this fund, say 2008, in the beginning of 2008, suppose you invested in this fund. This fund has delivered 34% negative return in year 2008. But by 2009 end, the CAGR become 20%. So 1 lakh invested after 1 year has become say 66 lakh, but after 2 years it become 1 lakh 45,000 perhaps, and then after 3 years again 19%. Then year 4 the return came down because in that particular year the return was negative. So after 5 year 10%, and after 10 year around 13-14%, and 11 year 13.77%. So if you invested in 2008, this is what has happened. If you look at year 2009, if you invested in the beginning of 2009, 2009 was a blockbuster year where the fund's NAV doubled in a 1 year time. So you got 114% return after 2 years, 60%, 3 years. And if you look at 10 year, around 20% return CAGR. If you look at 2011, suppose you invested in the beginning of 2011, the fund delivered 7% negative return. If you invested in the beginning of 2015, the fund delivered 12% negative return. So if you look at these 10, 11 years, well, you'll figure out that out of these 10, 11 years, 1, 2, 3, this fund in a 1 year time has delivered negative return. And in 1 year, the return has been around 4%. In one great year, this fund has delivered 114%. So whenever you look at investing in equities, you should be mindful that these kind of return will be there in the portfolio. If you look at, for instance, 2 year time, so if you look at last 10, 11 years, if you invested for minimum period of 2 years, then the worst this fund has delivered is 2% negative, and the best this fund has delivered is 60% annualized return. And if you look at 3 years time period, then twice this fund has delivered less than 8% return, or perhaps 3 times this fund has delivered less than 8% return. But beyond that, if you look at 5 year plus, then the worst return this fund has delivered in last 10, 11 year is 8%. But this 8% journey has come through this route. So it is very important whenever investor look at investing in the fund, equity will continue to deliver best investment performance, but be mindful that the journey, and nobody, no financial advisor, no financial expert can avoid this for any investor.
Yeah, I think the one takeaway from I mean, that I have via this as well, actually 2 or 3 key takeaways, and Vijay, please correct me if I'm wrong here, but if, for example, invested for a period of 2 years, staying invested means staying invested for a long period of time, but you invested for 2 years, then the worst possible return was minus 2%. The number of years that went up, your minimum return from one fund actually kept on moving up.
Yes.
One, that shows the benefit of staying invested. And two, I reckon if you just look at this example, that you started off with a negative return, 33%, 7% or 12%, your 1 year returns would have been negative, your 2 year returns may have improved, but essentially, if you stayed invested with this 33% downtick as well, your eventual return over 11 years was a healthy 14%.
Absolutely.
So if you stay invested, there's a very high probability that you would recover even if you had timed the market wrong. And usually, nobody can time the market.
Nobody can time the market. People do time the market, but
Try to.
But they do time the market, but it's always the other way around. They come when the market is rising. So most of the money came in 2008. Then we have seen huge money came in 2017, and we saw the result of 2017 as well. So large chunk of money comes when the markets are rising. For instance, in 2014, lots of money came because Modi government came in 2014, but 2015 was a negative year return. But if you look at this fund has the worst 5-year return in this fund has been 5%. But if you instead invested in the fund for 7 or 10 years, then the fund made huge return. Even after going through these numbers, and we'll show more slide, I'm not sure investor appreciate and understand and absorbs what has been communicated. When people look at these returns, they say, okay, fine, I'm fine with 10%, 20%, 30% volatility. But actually, when the day of volatility comes, then people get very nervous. So at that time, you need lots of hand-holding. I keep saying in the business of financial advisory, the return is generated by the market. In an 8-year period, return comes in 3 years. The job of financial advisor is to hold investor for balance 5 years.
Okay, that's very interesting. Well, I hope these charts help, and we'll of course get some more discussions going on some other numbers as well. But keep in mind, the broad idea of trying to show these graphics was, or trying to show this set of data was to encourage people to stay invested if you've indeed come in with a long-term perspective in mind. It's interesting, Vijay, you attached some probabilities as well to this, and again, we're using the HDFC equity fund as an example, but you attach some probabilities of positive returns, possibilities of 8% return. I believe you've chosen 8% as a hurdle rate because that's essentially the minimum rate of return or the inflation-adjusted rate of return that most people would anticipate.
Absolutely. So again, when we say equity delivered one of the best return, but also it is important to understand when the markets are volatile, how much volatility one can tolerate and what has been the worst return one could see. Whenever we go and speak to investor, they say 20%, 30%, I'm fine. But nobody understands actually is that even one of the best managed fund, 1 year return has been close to 54% negative. It means they have invested 1 lakh rupees and the 1 lakh rupees has become 46,000 rupees. Over a 3-year period, this fund's NAV in absolute term fell more than 20%. So even after staying invested for a 3-year period, the NAV is down 20%. So 1 lakh rupees, even after 3 years, is 80,000 rupees. And in worst 10-year period, the fund has delivered close to 5% return, and worst in 20 years has been 11%. I think there's some number need. I think there's something on the numbers. But if you look at what is the probability of positive return over a 1 year period, HDFC equity fund deliver positive return 73% time. It means 3 out of every 4 years this fund has delivered positive return. If you look at 5-year period, the fund has delivered positive return 95% of the time. If you look at 10 year, 100%. If you look at 20 years, 100%. So what we are trying to show that it is not cast in iron that even if you invest for 5 years, there's a guarantee the return will be positive. And if you look at probability of making more than 8% return, then I think your ideal investment horizon has to be 7 or 10 year kind of period. And the probability is very low, but you may see those kind of return. And that is the reason we communicate to all investors that never ever invest one time. You should always look at investing through staggered. So this probability of negative return comes down, and probability of 8% return, you don't have to wait for 5 or 7 years, perhaps it will come in 3.5 to 4 year time. So it is very important you stagger your investment as well. Don't invest at one time. But the most important messaging from this slide is that when you look at investing in equity, please keep in mind that if your investment horizon is 1%, 1 year, the return could be 54% negative, to 119% positive. If you ask me what will happen over 1 year period, I may give a very clever answer, but the fact of the matter is this: the return will vary from 54% negative to 119% positive. And it is draw of luck where you will get 54% negative or 119% positive. But the longer the time period, the probability of making money also goes up significantly.
Yeah, I think the opening line, though, the first row does give one solid indicator that the lowest return since inception for an HDFC equity fund, for example, over a 10-year period was 11%. So if you are indeed invested for that long a period of time, then your returns look fairly positive. So no complaints whatsoever. The other small topic that I want to touch upon before we ask one more question to Vijay on the other pressing issue in the minds of the industry right now. But the other thing that I want to Vijay to touch over is the edge that the mutual fund industry, in Vijay's terms, has in the Indian markets. Now, a lot of conversations that people hear about passive investing, Jack Bogle podcasts, move to ETFs, move to passive, and how they would do well. They probably could. They probably would over the next 20 years. Maybe they will, maybe they won't. We don't know that. But if history is an indication, Vijay, the industry is done well by and large.
Industry has done fabulously well.
Yeah.
But the noise of minority is too high because it is being lapped up by. It's very funny, I tell you. If you look at theory of economic and finance, most of them emerged from US or Western world. So what has worked there, people say it will work in India. Not necessary. Not every Indian kid grew up drinking Coke. But that has been taught to us that every new kid in India will drink Coke the way generation of 60 start drinking Coke. Didn't happen. The charge gave tough competition to Coke. Similarly, in the business of investing, there's a pad theory because this is what has happened in US, so it will happen in India. And believe me, it is not today. I'm in this business for 25 years. And even 25 years back, the same thing was taught: go for indexing, low cost indexing, low cost investing. And I think is a unnecessary battle we are fighting. You look at yesterday what kind of gold was bought, the quantity of gold which was bought on Akshaya Tritiya. And if you look at last 10-year return on gold is absolutely flat, but nobody questioning. Like you said, in equity debt investor, gold is a debt investment, and that's why people are buying it, because in spite of everything is not deliver a good return to investor. So in my opinion, in India, we are a developing economy. So in my sense, over at least in next 5 to 7 years, the equity portfolio manager will be able to add significant value. I take the same HDFC equity fund illustration and make you point. When this fund was launched in Feb 95, yeah, the fund's NAV was 10 rupees. At that time, I think BSE Sensex was something around 3,800. The fund's NAV is around 660 rupees today. The BSE Sensex grew 10 times. This fund's NAV grew 60 times. So
no, but we're choosing the best fund. What about the worst fund?
Even you look at the worst fund. So what you should do, I looked at 20-year, let's go back 20 years. If you look at average funds return over 20 years, they have been around 20%. We did one show with you, I think a year back.
Sometime
in
back,
last maybe 3 or 5 years, the large cap may not be outperforming, but it's just a phase in my opinion. And most of the underperformance has come in recent 1.5 year, because what is driving Sensex is actually 9-10 stocks. So forget about mutual fund. No PMS, no actively managed fund is able to beat those returns.
Okay, so Vijay does believe that mutual fund investing would have its advantages. Active investing would have its advantages. Therefore, hand-holding would be a key part for most retail investors. So keep that at the back of your mind, that mutual fund industry, despite all the noise, at least Vijay Mantri believes has the edge. Well, they're a fabulous product and by and large have been giving pretty good returns. Before we end the show, Vijay, just one question off topic now. We've established this, that one should stay invested for the long term, ideally, because that will help tide over volatility. And please learn that even if you're there for the long term, there will be periods of volatility which you need to manage. And if you can't manage yourself or your mind, then you need an advisor to handhold you. Having said that, Vijay, just one final question on the show, and that's off the topic, as I said, but a development that's happened on exit loads. Franklin Templeton Asset Management has abolished the exit load charge for switching from regular to direct plans. would you believe, I mean, how important this event, one, and two, would you believe that other asset managers would follow suit? Is this something that is an industry changing dynamic, or is this something that is a pretty routine par for the course event?
No, I don't think it is industry changing dynamic. If it would have been, then the direct plan is existence for many years. But if you look at new purchases, we don't see more than 15% or 20% new purchases happening in direct plan. So direct plans were available. Even if you look at last 3 months, 6 months, 1 year data, investor prefer to go through advisor. And in this kind of market where there's a lot of uncertainty about debt, how does one normal investor, I'm not talking about the corporate investor, how does one normal investor deal with these kind of uncertainty? So it is I don't think it is going to change the industry dramatically. Changing plans were available earlier. Suppose you were in a growth plan, you can move to dividend plan or vice versa. And that used to happen without an exit load.
No, but I have a follow-up question to that, Vijay. Let's assume that I had an advisor and I put in a lump sum money 10 years ago. I plan to stay invested for another 10 years. Now, obviously, that advisor is not advising me. I'm taking the help of somebody else and doing SIPs. But that money that I'd invested in a regular plan, now because there is no load, I can switch over that money to the direct plan of the same fund because the NAV would be higher, and therefore there is a small minimal gain there, right?
See, in most equity fund, the exit load is not there beyond 1 year.
Okay.
So suppose you invested 2 years, 3 years, 4 years back, it doesn't matter, you could switch even today. The maximum load, in my opinion, in the entire industry is in Franklin Templeton fund, where they have exit load even up to, in certain product, beyond 2 years. So perhaps they would have done it, but I don't think it is, in my opinion, industry, anything is dramatically going to change in the industry. But one point, last point I would like to make about HDFC equity fund. This fund's NAV has fallen 10% 54 times in last 23 years. It means every 6 months the fund's NAV has fallen more than 10%. The fund's NAV has fallen 20% every 1 year on an average. This fund's NAV has fallen around 50% 3 times in 23-24 years. So if you are investing, please keep that your portfolio will also fall in similar way, but every fall, next fall will be at higher level. So when your market drop, the NAV drop, the bottom NAV will be higher than last bottom NAV. So the market will go like this. But it is very important, before you look at the destination, you should keep in mind that the journey is equally important to understand, and then only you should look at investing in equities.
Okay, Vijay, on that note, thanks so much for taking the time and being with us today and giving us your thoughts. And viewers, thanks for tuning in to this leg of the Mutual Fund Show. Stay tuned to Bloomberg Live.